Good morning. It's Jeff Christian from CPM Group, 9:45 in the morning on Friday, the 17th of September here in New York. I hope you're all well. I've got several topics I will cover today. Gold is a fiat currency. The US Constitution does not specify that only gold and silver are money. Kind of very important topics in and of themselves, and probably also kind of incendiary. But I think it's fair and reasonable. Today is actually the 134th anniversary, 234th anniversary of the Constitutional Congress wrapping up its draft of the Constitution. Now, somebody will want to show his intelligence and say, yes, but the Bill of Rights, the first 10 amendments weren't drafted by September 17th, 1787. And that's true. But the Constitutional Convention ended on September 17th, 1787, and the draft Constitution was sent around to the various states for consideration. So it's kind of interesting that we'll talk about these things today. And then I'll talk about the market and what's happened this week, kind of an interesting time, and where we think it's going and why. So a lot to cover. First things first, gold is a fiat currency. It's kind of an incendiary, nasty topic, but you'll get my point. This is the price of gold, and I'm showing you this chart since 1968 when the gold price was free to float, so you can see the highs and the lows. And I'll say, you know, we're talking here about the real market. I don't want to, oh, well, yes, you can see every time that JP Morgan was suppressing the gold price or the Fed was suppressing the gold price. No. The gold price is determined by millions of people buying and selling on an ongoing basis. And we're actually working on some very interesting data that hopefully we can roll out and show in a future video in the not too distant future to accentuate that price making mechanism. But I wanted to show you that the gold price rises sharply and falls sharply. Sometimes it's flat for a long period of time. Sometimes it's volatile for a long period of time. And in order to understand gold and its relationship with other currencies, you have to understand what determines the price of gold. And people ask us that question all the time. And I say, you know, why was gold $260, $270 an ounce in 2000? And then went to $1,890 in 2011, and then went to $1,143 3 years later, and then went to $2,000 6 years later, and it's $300 lower than that today. Why was it $850 in January of 1980, $260 by June of 1982, and $500 by the end of 1982, early 1983? And the answer is that the gold price is determined by really millions of people in various geographic and sectoral markets of gold, bidding and asking prices, buying and selling. And the price is determined in each of those regional and sectoral markets by that interaction of buyers and sellers. And then the global price, insofar as there is one, is determined by the amalgamation of all those regional and sectoral markets. And by sectoral markets, I mean, if you look at New York, for example, there is a COMEX futures market, and there's a spot market, there's a COMEX spot price, nearby futures, active futures, and various forward futures prices. But there's also a physical spot market in New York, and there are forward prices, and there are forward markets, and those forward markets are different. The forward market that a privately owned jeweler in the United States or India or Thailand or anywhere faces is radically different than the forward market that a central banker faces, or that a bullion dealer faces, or that a producer faces. And one of the reasons why we saw the end of published indicative forward markets was people in the banking industry realized that there was really no efficient or honest or accurate way of saying what the forward gold price is. And you had these indicative forward prices that suggested that you could be paid to borrow gold because the indicative prices were calculated based on interest rates and the contango in the gold market. And that wasn't true. And regulators say, hey, these indicative price forward prices are not particularly indicative of the real market. You should do something. And they realized you couldn't, because even within a single bank, the guy who was dealing with a jeweler had a different forward price, given the creditworthiness of that privately owned jeweler, than the guy dealing with a large mining company, or the guy dealing with a trading counterpart at another bank, or the guy dealing with central banks. So even within a single bank, you had different forward markets. So those are the sectoral markets that I have referred to, and I will continue to refer to. So the gold price is determined by what people in the market feel is a fair price. In 2000, that consensus was $270. In 2011, that consensus was $1,890. Yeah, it varies depending on what people in the market say. Some people have larger positions in the market than others, so maybe they have more influence on determining the price than others. But it's really a market price that is determined just at large. Now, that's important to understand. The gold price is what the market says it is. People talk about a fiat currency, and we talk about a fiat currency when we talk about people who use the term fiat currency. And we say if somebody's using the term fiat currency in relationship to gold, you can stop listening to them. What is a fiat currency? The definition of something being fiat is that it's a formal authorization or proposition or a decree, or it's an arbitrary order. Arbitrary order. That means that sometimes we think gold's worth $270, sometimes we think it's worth $2,000, sometimes we think it's worth $1,780, and the next moment we think it's worth $1,760. Gold, if you look at nationally issued currencies, which some people call fiat currencies because they're floating, the value of those currencies is determined by the market. Now, half of the market is the supply of those currencies by that government, so that government is half that market. But the other half is the demand for those currencies. And the price of floating currencies is determined arbitrarily by the market on a continuing basis. The gold price, gold's value, is determined exactly the same way. Gold is, in essence, the price of gold is determined the same way the price of nationally issued currencies are determined. So gold is just as much a fiat currency as a nationally chartered bank currency. Now, you notice I'm talking about nationally issued currencies. I'm not going to even wade into the cryptocurrency issue right now. But gold is a fiat currency. Now, that's important. It's important for a variety of reasons. And I'll get back to that after my next topic. The next topic is the US Constitution does not specify that only gold and silver are money. Some people think that it does, and I'll show you why they're wrong in a second. And it's very interesting because years ago, I'm going to be at the Silver Symposium later this month. Years ago at a Silver Summit, someone pulled out these little pocket constitutions that right-wing people circulate and give out. And he said, Jeff, I was listening to your talk and the Constitution says this. And I said, well, let's look at your Constitution. And it was an abbreviated Constitution. It had certain very important words left out. I said, well, I happen to carry a copy of the Constitution on my computer. let's look at the full text. So that's what we're going to do here. In order to understand this, you have to understand, first off, the drafters of the Constitution were very smart people, and they struggled with every word. They worked for 126 days, including weekends, struggling over the phrasing of each sentence. Words mattered to them just as much, if not more, than they matter now. They worked very carefully to choose the right words and the right phrases. The Constitution has 4,543 words. They worked for 126 days, from May 17th through May 14th to 17th of September 1787. That was 36 words a day on average that they could agree to. Not counting the fact that for 10 years, from the completion of the Articles of Confederation in 1777 until the Constitutional Convention, they were working on doing a lot of preliminary work, because as soon as the Articles of Confederation were agreed upon in 1777, they said, you know, this isn't going to work. We're going to have to do something better. And, you know, the Constitution said, we the people, in order to form a more perfect union than what? First off, oh my God, the unionists? Second thing is a more perfect union than what? A more perfect union than the one that we formed 10 years earlier with the Articles of Confederation, right? So they spent 10 years, let's say, discussing what should be in the Constitution before they spent another 126 days deciding each word. So that's really important to understand. These guys were very explicit in their word choice. Another thing that's important to note, and you'll see that in a second, is the first Bank of the United States was established in 1791. They were talking about how they should have a central bank and the need for a central bank. And the treasurer, Alexander Hamilton, said, yeah, we need a bank. And that was very important because that shows up in understanding Article 1, Section 10. People who tell you that the Constitution says that only gold and silver are money in the United States always refer to Article 1, Section 10. And that little book leaves out something important. Article 1, Section 10 in the Constitution, the powers denied to the states. And what Article 1, Section 10 says is that no state shall coin money or emit bills of credit or make anything but gold and silver coin a tender in payments of debt. So it says, okay, we're talking about what the states may not do. The states may not issue money. And much more importantly, the states where it mentions gold and silver are mentioned only in that the states can only repay their debts in gold and silver. So that tells you, Section 10 tells you what state governments may not do. It says nothing about what the federal government can do, and it says nothing about a national currency. Now, the historical context is that during the Revolutionary War, they issued continental notes, kind of worthless pieces of paper, fiat currencies. And a lot of the state governments used those currencies to finance their portion of the war effort. And they had to pay those debts that they had borrowed, these continentals. They had to pay those debts back to the federal government. Alexander Hamilton wanted gold. He wanted to build up gold and silver reserves for the treasury, for the federal treasury. And so he fought very hard that in Section 10, the states specifically have to pay their debt to the federal government in gold and silver. They didn't say anything about coining money in gold and silver. All he said, and all the Constitution said, and you know, the legal term is the four corners of the document, is that the states may only pay their debt, which was to the federal government, in gold and silver. And that was expressly so that the Treasury could build up its gold and silver reserves. So Section 10 tells you nothing about a national currency. In fact, Section 8 does. Section 8 is the powers of Congress. And it says that the Congress has the power to coin money and to regulate the value thereof, as well as to regulate the value of foreign money or foreign coin. Okay, Section 8 tells you what the Congress may do. Okay, logic tells you the value of anything cannot be determined or measured by the value of itself. If I say I have an ounce of gold and say, what's the value of it? Well, the honest answer is it's worth an ounce of gold. And that was $1,757 this morning, then it was $1,762, now it's $1,760. If you're talking about regulating the value of the money that you're creating, you cannot say, I'm creating money, it can only be gold and silver, and the value is weighed as the value of gold and silver. It's simple logic. It's logic 101. And in fact, if you studied basic logic in high school or college, that was one of the first things that you learned. You cannot measure something by itself. Yeah. Number of ounces per ton is the number of ounces per ton. You don't see people saying, well, you know, a metric ton equals a metric ton. The value of anything can't be determined by measuring, can't be measured by itself. You have to measure the value of gold and silver by something else, and you have to measure money by something else. And what the Constitution says is that the Congress should determine the value of money, and the way that money was valued in 1787 was how much is that dollar or mark or pfennig or franc worth in gold and silver. Gold and silver were the measures of the value of money. They were not money in and of themselves. They were the measures of the value of the money that the Congress was authorized to coin. Right? Now, that's very important. Gold is just as valuable as a fiat currency. The value of gold is determined basically the same way a value of a fiat currency is determined. And the Constitution does not in any way say gold and silver are the only forms of money in the United States. These are important factors in and of themselves. They're important also because a lot of people have inaccurate beliefs about these two factors. And they're also important for a third reason. If someone is talking to you about fiat currencies relative to gold, or they're talking about how Section 10 of the Article 1 of the US Constitution says only gold and silver are money, you can stop listening to them. Yeah, they either don't know what they're talking about or they're consciously saying inaccurate things. And in a world where none of us have enough time to do everything we need and want to do, one of the ways that you streamline your lives and make them happier is to get rid of those things that are just distractions, like listening to people who are either spouting off about something they don't know or consciously, purposefully saying inaccurate things. I know that's a little incendiary, but it's the ugly truth of the world. Now, market outlook. Gold and silver fell sharply this week. They fell sharply because inflation figures actually came back relatively sanguine. You know, people were looking at year over year, 5.3% increase in headline inflation, 4.0% in core inflation, ex food and money, food and energy. But that's measuring it from last August. If you looked at it July to August, what was the monthly inflation in August? It was very sanguine. The only thing that was more than 2% increase was oil, petroleum-based energy. Other things were declining or they were less than 2%. Used cars, which have been double digit, like 40–45% per month increases in the prices, actually declined like 1.5%. So the inflation figures, once you analyze them, you can see that a lot of the inflation that we saw April, May, June, July actually was transitory. Now, 1 month doesn't make an end of transitory inflation, and we expect higher inflation figures going forward. But those numbers that came out this week on inflation were actually pretty good. You had strong retail sales too. You had a number of factors which sort of suggested that, hey, the Fed might not have to tighten interest rates anytime soon, that the Fed seems to be on the right course. You saw 10-year bond yields fall as a result of all of this, and you saw people back away from gold and silver on a temporary basis. We're surprised that the prices fell as sharply as they were. And some of folks have realized that, we sometimes get our short-term projections and expectations wrong. So we thought that the gold price and silver prices would fall in August. They did in the first week of August. We thought they would stay weak. They didn't. They rose. And we were saying, hey, no, we think that these prices are going to stay weak, so we wouldn't necessarily buy. And anybody who took our advice in August on a short-term basis got it wrong because the prices rose. I said, okay, prices were stronger in August than we had expected, and we think that they're going to strengthen in September through December. So it's time to change our views and say, okay, it's time to go long. No sooner had we said that than the gold prices and silver prices fell. They fell to the low end of these ranges that we've seen. For gold, 1780 to 1820. For silver, $23 to $24.50 roughly. They fell to the low end of that range. And we said, okay, this is probably a buying opportunity because we're still in those ranges. At which point this week, the prices fell below that. We change our short-term market views as the short-term market changes. Right now, our view is that the prices are probably oversold on a short-term basis. We do think the prices are going to rise in the short term as well as in the long term. I was talking to some people last month, and somebody said, why is it that the anti-vaxxers don't like Dr. Fauci? And I said, well, Dr. Fauci changes his mind when he learns something new. And they smile. Yeah, if you don't want to change your mind when you learn something new, that's fine. It's a free country in the United States, more or less. But we change our minds in line with the markets. We make expectations. We have 10-year projections for gold and silver, 30-year projections for platinum group metals, 20-year projections for manganese, 30-year projections for overall economic activity on a global basis. So we have long-term views, we have short-term views, and we have intermediate views. And as the market changes and as the economic and political and financial landscape that determines investment demand, as well as fabrication demand, mine production, secondary recovery, as things change, we change our views. And that's the way it is. And to be honest with you, in terms of our trade recommendations, we think that you should have an even shorter term horizon on your views than our trade recommendations give you. Trade recommendations tend to be for the next 1 or 2 weeks, and probably if you really want to be a good short-term investor, you should be looking at the market constantly. We have other things to do that are much more interesting and intellectually rewarding and financially rewarding. So we don't have traders sitting there. We are investors and investor advisors, not traders and trading advisors. And one of the reasons why we prefer options to ETFs, forwards, and futures is because they can protect you from getting your projections wrong. So that's why we do it. We're looking at gold We think it's oversold. We think it moves back towards 1770, then 1780. And ultimately, over the course of the next few months, we think that the price continues to rise. We wouldn't be surprised to see a spike to $1,900, depending on what happens in the world, because the world remains a very treacherous place. And we still are on record as saying that we think that prices will rise even more sharply beyond 2021, 2022, probably to record levels in 2023, 2025, 2026. We don't see it going to $10,000 or $20,000, but we do see it rising sharply over previous records of around $2,000. With silver, we also think it's oversold. We had thought that it could go down to 22 as it did earlier this year. It got down to like 22.54 yesterday. These markets are still vulnerable to the downside, but we do think they're oversold. We're looking for the price. The price is, I think, testing $23, which was its floor. Now it's its short-term ceiling. We think it does move above $23, and it moves back into that range. And we've been talking about a range of $23 to $28 for the last 4 months. Our view on the last 4 months of the year is that the prices will trend higher. Seasonally, that's what's happened. The last 2 years, that seasonality has been overridden by other things. In late 2019, there was a burst of optimism about the economy. And while you had a lot of people worried about moving into a recession in the middle of 2019 with a lower dollar, by the last 4 months of 2019, the dollar was stronger and the economic outlook was perceived as being better. So people backed away from gold and silver and the price fell. In 2020, in the last 4 months, we saw the gold price and silver price weaken. After the gold price had reached a record price in August, and silver had also risen very sharply to almost $30 an ounce. You'll have to excuse the fact that I live in New York and we have constant sirens. That sounds actually like an ambulance going to the nearby hospital. So we've seen prices weaken over the last 2 years in the last 4 months. Our expectation is that this year that may not happen. Last year, as I was starting to say before the siren interrupted me, last year we had a situation where we were coming out of the lockdown. Things were starting to improve economically, and there was a movement away from gold and silver as safe haven portfolio diversifiers. And there was also a lot of people who said, okay, the prices reached record highs in early August and fell over the course of August, so I'm not interested. They rekindled their interest in January and February of this year, and then they backed away again. We think that that interest will be rekindled slowly and modestly initially, more strongly as over the next 2 or 3 or 4 years, and that we are on the lookout for events that might trigger spikes higher, at least on a temporary basis. I think that's about all I've got right now. I hope that explains our market outlook sufficiently. I am going to the Silver Symposium. I've mentioned this the last couple videos. I'll be there on Monday talking about silver past, present, and future. You know, supply, demand, prices, what's really going on in the market. They've informed me that there's an expert panel meet, greet, and eat event that evening. I think it's a special ticket item, but it's like 2 hours where other people and I will be around to talk to conference symposium attendees. On Tuesday, I've got Challenge Your Assumptions, an open question and answer period. It's only an hour long. You hardly solve the world's problems in an hour, or at least delineate them more accurately than often delineate it. And I'm doing a workshop on investing in gold and silver in a world that's not collapsing. Yeah. One last thing, you know, I keep getting these emails that President Biden is going to ban Bitcoin. I don't think he can. I mean, you know, we have a saying in CPM Group. I have a saying. I've never heard anybody else use it. But you know, you hear these outrageous things, and I won't say the saying because it's a little bit crude. But It basically is, before you act on what you just heard, take a break, walk down the hall, go to the men's room or ladies' room. And while you're doing that, think about that. Is that even a doable event, much less a probable event or a possible event? And you stop to think and say, wait a second, how could the president ban Bitcoins? I mean, Bitcoins exist on the internet. That's like saying that you're going to ban picking noses. It's probably a more useful ban. But again, how are you going to enforce that? You can't enforce it. It's just total nonsense. And why is it there? Because someone's trying to sell you gold and silver at an excess premium. Don't listen to them. Life's too sharp for that. Maybe I'll see you in Idaho. Regardless, I'll be with you again probably next week a couple times. Have a good weekend.